Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you today, and as always, send your questions to Brian Rezny at ReznyWealth.com, and make sure you do visit our website, ReznyWealth.com. You know, for the last 35 plus years I've been managing portfolios professionally. We deal with thousands and thousands of people throughout the year, not only on my TV, radio shows with questions, but of course actual clients that we're managing their portfolio. Nothing gives me more pleasure than really to help you, the investor, stay on track and make good decisions, sound decisions around your portfolio. One of the things I want to talk about today is it's time to change up your portfolio. And really, what does that mean? We will often get calls from potential new clients, let's say at our office, and they will say stuff like, you know, my advisor right now just kind of sets it and forgets it. We don't really hear from our person that often. The only time changes are made is when maybe we contact that firm and we're kind of complaining about how can we still own this investment that's been there for 5 years and hasn't gone anywhere but down, things like that. So one of the things that I want to stress is this. There are times you need to make changes to your portfolio, and that doesn't mean every single day. At our firm, because we're an actual money management firm, we're doing a lot of research every single day, not only on the economies of the world, but also the investments in our portfolio and new potential investments we may want to include. We make changes when there's better opportunities for different investments in our portfolio based upon the economic climate and or valuation. So as an example, and I've talked about this a few times this year, one of our major sector bets that we had was oil. And we bought oil because it was so cheap a few years ago. Now, we may not own oil for the next year, 5 years, or maybe the next month. At some point, we're going to sell oil for a profit, hopefully, and we're going to move on to another greener pasture. But right now, oil looks pretty darn good because of the margins and supply chains and really the current administration war on fossil fuels, which has the potential to keep oil prices high, which is great for oil investments in general. But again, do your own research. So change is good, and there are times you need to change up your portfolio to better your position. Let's talk about sky-high interest rates. There's another thing that's coming in a lot from my TV and radio show listeners, which is, Brian, do you see Jimmy Carter-style interest rates like we did back in the 70s? We do not see that. The number one reason we don't see that is simple. There is so much debt owned by our government and other governments around the world and individuals. Sky-high interest rates would crater the whole world economy. I see interest rates going up a little bit more, but not a lot. And the reason for that, again, is sky-high debt around the world, individually owned, corporate owned, and of course, mostly in the government side. They can't afford to pay the bill if they raise rates to 15% like in Jimmy Carter days. So we see modest interest rate increases. So again, your CDs are not going to pay a lot, but overall, I see inflation overall coming down quite a bit. A little bit about recessions. This is the other hot spot with a lot of you listeners out there. You get inundated every single day in your inbox or on the media about recessions imminent. We're in a recession, things of that nature. Recessions are not bad, by the way. Recessions are actually great buying opportunities to either A, reposition some of your money, or maybe sell an investment that's done okay and buy other investments that are much cheaper now because they've come down off their highs that maybe you wanted to buy before, but they were overvalued. Recessions come around every 6, 7, 8 years on average. Remember, recessions are not bad. They're great buying opportunities if you're properly managing your personal portfolio or the money management firm you have is actually managing your money. So don't fear a recession, embrace a recession as long as, again, you understand how money management works and you're properly positioning your portfolio. I told you so. That's a quote from me on the bond market and false sense of security. Over the last 4 or 5 years, I have talked repeatedly about low interest rates and low interest rates on bonds and how bonds react to interest rate increases or decreases. Remember, bonds are like a teeter-totter. If interest rates go up, bond values go down. So ultimately, when I said I told you so, I repeatedly warned investors on my TV and radio shows, make sure that you own less bonds, maybe a little bit more cash if you're trying to be more conservative, but own the right type of bonds and maturity. Shorter term maturity, like a teeter-totter, doesn't move as much. And again, we see interest rates ultimately moving up a little bit more, not a lot. But I think investors are oversaturated in bonds. And if you take a look at the bond market as an example, even government treasuries, which are supposed to be one of the safest investments in the world, take a look at how that performed the first half of this year. Long-term government bonds were actually down more than most of the equity markets. And you're like, what? I thought bonds were safe. They can be as risky and as volatile as the equity market. But unfortunately, a lot of investors don't really understand how bonds work, but they think that they don't go out down in value, and they can, and a lot, and they can default. So yes, you could lose all your money in a bond if it does default. So again, false sense of security, I think a lot of people have that in the bond market, and there are times you want to own less bonds and maybe more cash, just because that's the right thing to do if you're trying to be a little bit more cautious and have capital preservation. Let's talk about what investors do too often, and that's called buy high and sell low repeatedly. One of the things I've tried to always educate every one of my TV and radio show listeners is learn from others' mistakes because it's less costly to you, the investor. What does that mean? Investors like to always chase, for some reason, what's already made the most return from last year. They scour through different publications, or they hear on some of the media and the hype on XYZ mutual fund had the best return last year, or this ETF or this stock had 120% return. So what do investors do with their money? They go put more money in something that already is grossly overvalued without research, and they buy more of that. So if we look at this year as an example, we've already had a major correction in the equity markets around the world. Just in the U.S. alone, these high-flying growth stocks, the things like Pelotons of the world or GameStop that are making no money and are losing money, that are still traded at valuations that are nosebleed. Most of these stocks are down 50, 60, 80% year to date. While quality companies that are actually making money and probably will be around the next 3 to 5 years and probably will have a chance to make more money have only come down 15 or 20%. Those are some of the better opportunities. Stay away from these high flyers that were up 120% last year that have no earnings and have crazy valuations, because if you buy investments like that, you're going to burn yourself. And again, we get a lot of phone calls, email questions on my TV radio shows about these high-flying investments. Should I buy those because they did so well last year? The things that did the best last year, realistically, if you look at historical data, usually do the worst or very mediocre the following 1 to 3 years after that. So just remember that. I'm going to take a quick break. So make sure you do send us your questions to Brian Rezny at Rezny Wealth, and also make sure you do visit our website, ReznyWealth.com. We've got a whole bunch of great information on our website. You can also go to our website and sign up for a consultation or call our office for a consultation. One quick note, our client minimum is $1 million to start with our firm. But because of this current market downturn and because we are going to look out for you smaller investors, we're going to temporarily, only until the end of this year, we're going to reduce our client minimum, new client minimum, to $500,000 or greater to help out you investors who maybe weren't getting the best advice from your current advisor. Maybe you're self-managing and realize you don't really are not doing the best job either. So call my firm. This is a limited opportunity to work with a first-class money management firm like Rezny Wealth Management at our currently reduced only to the end of the year, $500,000 minimum to start with our firm. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. I hope you're enjoying today's program. And again, send your questions to Brian Rezny at ReznyWealth.com. I want to go to my first question today, which is Tim in Naples, Florida. I have approximately $300K portfolio, down 57% over the last year. I bought mostly well-known tech stocks like Shopify, Zoom, and NVIDIA. What do you think of these? Tim, great question. Let me tell you what, my previous segment, I talked about buying high and selling low, and that's what investors for some reason do all the time. The stocks that you are citing, really Zoom and Shopify, are just grossly overvalued, even with the current downturn that you've already experienced in your portfolio. Remember, the S&P after the second quarter was over was only down around 18%, and those stocks were down 60 to 80% that you are citing. NVIDIA, I actually like the stock, and I think as a part of a portfolio long term it has opportunity, but it's still somewhat pricey generally speaking. As an investor, if you are grossly overpaying for a stock over market multiples, chances are you're gonna get burned and burned bad. So being down almost triple what the market is year to date, that's pretty bad, and it tells me you probably need to find yourself a professional money management firm that could really help control the emotion part of you investing and properly manage your money with real research and strategy over the long term. Larry in Dallas, Texas. What do you think of long-term bonds now like TLT? Great question, Larry. TLT is an ETF, folks. It owns long-term average 20-year maturity government treasuries. I would not buy TLT. I would not own any bonds, whether it's government treasuries or corporates, that are more than about a 3-year average maturity. Rates are still going to probably go up a little bit. And I think ultimately going out that extra 15 or 18 years on maturity just for a little tiny bit more interest makes no sense. Remember, it's like a teeter-totter. The farther you are at the ends of the teeter-totter, that's bonds, the more volatility and risk you take. It makes 0 sense to get paid 3% or less on long-term government treasuries when you can look at maybe other investments that you can build into a portfolio that really, to me, have less risk, have a dividend stream and potential growth for a total return maybe in the 5 to 8% arena. So long-term bonds of any kind at this point in the cycle, to me, is a no-no, and I think if you do it, you're making a major mistake. Steve in Cape Coral, Florida. What do you think about airline stocks? Don't buy them. I do not like airline stocks. I've never liked airline stocks. Let me explain why. The airline business, while it's a valuable business because we all like to fly, investing in airline stocks can be really detrimental to your wealth. Airline stocks, obviously, just to have an airline to buy the planes is huge capital intense. The economy fluctuation has big impacts on how their profitability is. Remember, just in COVID a few years ago, the airlines were all basically shut down. They were almost all going to go out of business and bankrupt. So, of course, what does the government do? They lend them money to keep them in business. They got to pay that money back. It's going to take them 10, 15 years of future profits just to pay those debts back, let alone the other debts they had from before COVID. Airline stocks are low margin business, they're high risk businesses, or capital intense. Just avoid airline stocks. There's so many other greener sectors or pastures you can look at and invest that, in my opinion, have a much better opportunity than the airline stocks would. I'm going to go to a quick break. Make sure you do send your questions to Brian Rezny at ReznyWealth.com. And remember, we are reducing our new client minimum. We've had an overwhelming response from you, our TV and radio show listeners, asking, hey, my account is down with my current advisor. I'm not at your 1 million minimum. Will you make exceptions? We're going to do that only through the rest of this year. So if you have at least a $500,000 portfolio or greater, we will make an exception and bring you into the fold at Rezny Wealth Management. But again, this is a limited time. Go to ReznyWealth.com, click on that consultation tab, or you're more than welcome to call our office. I'll be right back after this. Hopefully you're enjoying today's program, and as always, Brian Rezny at ReznyWealth.com is our email address if you want to send us questions. I want to jump right to Barbara in Naples, Florida. Hi, Brian. I have an advisor at Wells Fargo. Is Wells Fargo a fee-only fiduciary money manager? Have they ever been fined, as you've discussed on past shows? How do I check them out? Wells Fargo is really a bank, brokerage firm. It's a whole bunch of different things rolled into one. Wells Fargo, no, is not a fee-only fiduciary money manager. They do some fee-based work and a lot of commission work and manufacture a lot of products. Has Wells Fargo ever been fined? You can go to the FINRA or SEC site, and clearly they show billions of dollars in fines over the decades against misdoings or things they've done wrong. Again, the SEC and FINRA are the two major regulatory agencies that would oversee a Wells Fargo. And it's unfortunate, but I think a lot of investors never check out the firm they entrust their money. If you go to ReznyWealth.com and you scroll to the bottom of our homepage, you can download for free Real Advisor, Fake Advisor. And at the bottom of that report, we'll list both the FINRA site and the SEC site, so you can check out all of the firms, whether it's a Wells Fargo, whether it's a Merrill Lynch or a Bank America or an Edward Jones. You can check out any of these firms, and I always suggest every investor should always check out the firm they entrust their money to, because again, if a firm's been fined $1 million or $1 billion for misdoings against clients, that's not right. And you should understand that they've been fined and what they've done to previous clients. It's not a guarantee that they'll do it in the future to new clients, but let's face it, it's good to know what's happened in the past so you can make an educated decision about who you want to entrust your life savings to. And again, protect your money, check out the firm you entrust your money to. Dean in Fort Myers, Florida. What do you think of annuities, equity index annuities with bonus and income features for life? Dean, in general, annuities are complete junk. There's two types of annuities. There's fixed annuities, or these equity index annuities, and there's variable annuities. Both come with big surrender penalties to get all your money out for long periods of time. They all come with excessive fees, which is bad for your return. Annuities are a manufactured product by insurance companies that are sold, in our opinion, to unsuspecting investors, Dean, like you, who maybe don't understand all the fine print. Annuities are highly complex, they're expense-ridden, and unfortunately investors often are either lied to by the so-called advisor about how these bonus features work or these income features work, or maybe you just didn't understand how they work. But annuities are no free lunch. If you get yourself into an annuity, it'll take you about 2 to 3 years from what we've seen until you finally realize you were duped into a really crummy investment. Now you want to get out. But what you find out is you still have another 8-year surrender penalty at 8%, let's say, to get all of your money out. So what do? You stay with this bad investment because you don't want to lose another 8% along with what you've already lost in previous return possibilities. So again, instead of going to that free steak dinner, instead of buying an annuity, the best thing I will tell you is don't touch an annuity. And if you want to find out more why annuities are dangerous to your wealth and retirement, go to ReznyWealth.com, scroll to the bottom of our homepage. Right there, we have a free report. Why annuities are dangerous to your wealth and retirement. Read it twice. Educate yourself. Don't let these annuity charlatans who claim to be fiduciaries, They're not fee only. They're not money managers, but their whole operandus is really to sell you a crummy annuity with a huge commission to them, which is detrimental to your financial security and your retirement. Wally in Naples, why is there all this talk about the recession when the economy is doing so well? Wally, you got to remember, the media likes to hype everything. The more you watch a particular station or a show, the more the ratings go up. So you got to remember, TV and radio, generally speaking, is a lot of hype, not a lot of substance. And what happens on most of these news programs is they just want to do these little sound bites to get you to watch. A lot of listeners, they get more advertisers, they get charged more because they have more listeners, and you can kind of see how the cycle repeats. Now, while we are definitely seeing somewhat of a slowdown in the economy a little bit, we do not see a major recession currently on the horizon. Now, we may change our tune in 3 or 6 months as our research dictates, but generally speaking, the economy is moving along. We're obviously coming out of this pandemic in a good way. The biggest problem we have ultimately is energy prices and inflation. Those need to come down for us really to have a better leg forward in a growth pattern in the U.S. economy and the world. I'm going to take a quick break. When I come back, we're going to take more questions. Send those questions to Brian Rezny at ReznyWealth.com. And remember, we've been inundated lately with the markets being down from our TV and radio show listeners, you who would like to hire Rezny Wealth Management. Our normal account minimum is $1 million. But because of this current downturn, what we're going to do is help you, our TV and radio show listener, and we're going to reduce our current client minimum for the rest of this year, if you want to hire our firm, to $500,000 and greater. So this gives you a great opportunity for world-class money management. Call Rezny Wealth Management or visit our website. Click on that consultation tab at ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. Judy in Estero, Florida. We have most of our money invested in mutual funds. We are not happy with our current advisor. Can you explain what a fee-only fiduciary money manager is? Great question. And I do talk about this a lot. And by the way, if you visit ReznyWealth.com, scroll to the bottom of our homepage, you can download for free Real Advisor, Fake Advisor. So let me explain. In our estimation, about 10% of firms nationally are what's considered a fee-only fiduciary money manager. Fee only means the only way they're compensated is the fee they charge you to manage your money, Judy. Fiduciary means they legally work for you 100% of the time. So that means they always have to put your interest ahead of theirs. Fee-based firms are not fee-only firms. And by the way, all these Wall Street firms and banks have jumped on the fee-based wagon, but they still have all the conflicts and added costs of kind of the typical brokerage house, insurance company, and bank. So again, no bank, no insurance company, no Wall Street style firm is a fee-only fiduciary money manager. Now, money manager means we actually manage the money. What's interesting, if you go to like the big bank down the street and they have a wealth management department in the bank, what happens is their advisors are really acting really more as a sales representative for the products they're required to sell through that bank. Now, they might sell you a fee-based account and have a lot of other added costs and conflicts which they have to disclose. But that advisor really is not a money manager either. They're probably selling somebody else's services. So again, what you want, Judy, if you really want real money management, you want a firm that 100% of the time works for you as a fiduciary and actually manages your money, look for a fee-only fiduciary money manager like a Rezny Wealth Management. And make sure when you do interview that firm after you're done, check them out on the SEC site in FINRA. Again, the best way to do that, download our free report on our website at the bottom of the homepage. Real Advisor, Fake Advisor. Protect your wealth. Download the report. and make sure you always check the firm you entrust your money to for misdoings against you, the client. Carl in Cape Coral, Florida. I am 64, retiring next month, and my current advisor is suggesting to roll over my 401k plan to an annuity. What are your thoughts? Carl, do not do it. Your current advisor is not an advisor, it's a salesperson, fancy title for a salesperson. They're trying to sell you a expense-ridden, complicated annuity so they can make a big, gigantic commission. And once you get into that annuity, Carl, it's going to be pretty much impossible for you to get out without a big surrender penalty on the back end. What you need to do, Carl, is download, again, we've got another free report about annuities, why annuities are dangerous to your wealth in retirement. It'll describe a lot what I'm talking about. Go to ReznyWealth.com, scroll to the bottom of our homepage, and download that report. Carl, there's no reason you would put an annuity in take a 401k plan and put that into an annuity. Your 401k plan would go into a self-directed IRA, which is tax benefit, meaning it's tax deferred. You would escape all the cost structure by not buying the annuity. You would escape the cost structure and the surrender penalties by not buying the annuity. And remember, once the advisor, so-called advisor, sells you that annuity, you're never going to hear from that person again because they've made their commission. You're locked into that annuity maybe 10, 14, 15 years before they can reload you into another commission product. So bottom line, just don't do it. Dan in Naples, Florida. I have most of our wealth in bond investments. Some of our bonds lost money in the last downturn. I thought bonds are safe investments. Dan, unfortunately, a lot of people just like you think bonds are safe, and bonds can be as volatile and potentially as risky as the equity market, real estate, gold, or any other investment, depending on the economic cycle. So bonds, realistically, if you lost money in bonds, chances are you had the wrong type of bonds, the wrong maturity bonds, or you had too much in bonds. Bonds are a building block in the foundation of your portfolio. And there's times where you don't want to have any bonds in a portfolio or certain types of bonds. And there's times you want to maybe have more cash than actually have bonds in that portfolio. So remember that. Bonds are not a safe investment. They have volatility and they can default and you could lose all your money, just like most investments out there. So just make sure you understand that. And as always, if you need more help with your portfolio, you're more than welcome to call Rezny Wealth Management for a consultation. We'd love to see if we can get you back on track. As always, folks, I'm just about out of time right now. I want to make sure that if you have any questions at all, make sure you send those to Brian Rezny at ReznyWealth.com for future shows. If you're tired of bad advice, poor client communication, and feeling like your advisor is just not up to the job, it's time for a positive difference. It's time you call Rezny Wealth Management for real money management and real advice. Honesty, integrity, compassion, and competence is the difference Rezny Wealth Management provides all of our clients. Go to ReznyWealth.com. The number one comment we hear, I should have come in for a consultation sooner. If you're looking for money management services, call our office during the week or visit ReznyWealth.com. Click on that consultation tab. And remember, only until the end of this year, we're making an exception to our client minimum of $500,000 on up. Go to ReznyWealth.com. That's ReznyWealth.com. I'll see you next week.